2021, whatever it was, basically when they were just like giving away money, and you could leverage to yeah. Do you think that this is it? I mean, like, do you think that we're returning to that kind of day when the technicals kind of snowball and lead to these? I don't know. I don't want to say inappropriate rallies, but definitely rallies that seem to be outsized based on what the catalysts are.
Yeah, well, I mean, don't forget that Bitcoin has perfectly inelastic supply, right? And so when demand rises, and what you saw over even in the bear market in 2022 is that holding trends remain strong, and much people and a large part of supply was really held throughout that bear market. So ultimately, it continues to be more scarce, and when you have that demand, of course, you're going to have these rallies that can really, really take hold. And of course, traders like to get involved. There was some shorts. There were a lot of people that were confident in Q4 that they were going to see lower prices, and I'm sure some of those were liquidated. And now you're starting to see open interest rise across some of the futures and perp platforms, and that's a sign that traders are again entering space. And certainly, the beginning of a new trend, the rise in open interest does show that there is interest in following that trend.
Yo, what up, y'all? It's your boy Rob coming back at you once again with another video. So before we get started, you already know what to do. If you're not subscribed to the channel, make sure you hit the bell icon twice. Smash the like button, share this video out to all of your followers, and let's get it cracking. All right. So what we have today is an article from CoinDesk. All right. It's been a minute since we've talked about cryptocurrency. It's been a minute since I've gone live on Tales from the Cryptocurrency. If you're not subscribed to that channel, make sure you take a moment and subscribe to it. And we will definitely be dropping more economic videos soon. It's just been so much stuff coming out in the news. It's been difficult for your boy to be able to get all of the videos made. All right. So I was actually able to get one made. So in this article, they're talking about Bitcoin being primed to rally to $56,000 as NASDAQ breaks out of a bull flag, chart analysis says. So now what I want you guys to do is let me know, based on how much cryptocurrency you may or may not currently hold, if Bitcoin goes to $56,000, what will that do to your portfolio? In most cases, beautiful things. Beautiful things, you know what I'm saying? The analyst who correctly predicted the late 2020 bull run said 2023 could be surprisingly a good year for both crypto and equities. All right. So what we're going to do is we're going to take a look at this video right here. And we also have some other articles that are going to be talking about the economy as well. And if you're interested in economic content, also make sure that you subscribe again to Tales from the Cryptocurrency and to Oil and Gold Railroad.
We've seen this spike in Bitcoin, and it seems to coincide at the very least with this recent BUSD debacle or situation with the SEC. Do you think that there's some connection there, that this is not so much a rally in Bitcoin as it is a sell-off in BUSD?
Yeah, so I think, when you kind of consider where the rally started, and, of course, it started with a low in November, and it really picked up in early January when it kind of regained that mid-June low around 17,800 and really rallied to a point where up until 25,000, of course, it's likely might have to do with some of those.
So my question is, had you been buying Bitcoin the entire time while it was at 17,000? As of right now, as you can see on the right-hand side, Bitcoin is at $22,444. How much money would you have made? How much improvement would you have seen in your portfolio? Let me know in the comment section.
Players kind of getting out of BUSD and or even out of alts in general after some of the recent regulatory angles that the SEC is taking. But really, have been flows towards Bitcoin. But ultimately, the rally began, and it's more of a technical rally. And of course, it's one that's against all odds, and one that really came in the face of a lot of uncertainty in terms of what happened post FTX. But of course, kind of as I mentioned throughout many times coming on this show in late 2022, the second half of 2022, is that ultimately the macro conditions were improving. And of course, you had the FTX news kind of slap the digital asset rally in the face, but that kind of moved to the rear view. Little contagion, little forced selling to follow. And now you have that technical rally up until again, a relentless rally that really was 2 weeks of essentially wiping out 5 months worth of gains. So, Bitcoin does rally when those least expect it. And I would consider now the price being above the 200-day moving average as just another signal that, this could be, again, the beginning of a new bull market.
Yeah, do you think those technical aspects of it in part played a role in some of the liquidations we saw? Now, leverage isn't what it used to be, of course, when and during the halcyon days of 2021, whatever it was, when they were just like giving away money, and you could leverage to. Do you think that this is it? I mean, do you think that we're returning to that kind of day when, the technicals kind of snowball and lead to these, I don't want to say inappropriate rallies, but definitely rallies that seem to be outsized based on what the catalysts are?
Yeah, well, don't forget that Bitcoin has perfectly inelastic supply, right? And so when demand rises, and what you saw over even in the bear market in 2022 is that holding trends remain strong, and much people and a large part of supply was really held throughout that bear market. So ultimately, it continues to be more scarce, and when you have that demand, of course, you're going to have these rallies that can really, really take hold. And of course, traders like to get involved. There was some shorts. There were a lot of people that were confident in Q4 that they were going to see lower prices, and I'm sure some of those were liquidated. And now you're starting to see open interest rise across some of the futures and perp platforms, and that's a sign that traders are again entering space, and certainly in the beginning of a new trend, a rise in open interest does show that there is interest in following that trend.
Such as on Binance.
All right. So we've got this Bitcoin parabola chart, and so analysts expect a continued move higher, and that Bitcoin could see more than double in value in the coming months. And this information coming from emerging asset groups, William Noble telling CoinDesk that Bitcoin could move from consolidation to another parabolic move back to $56,000. Going parabolic is an expression we often use in the crypto market to describe an expected impulsive move higher with limited downticks. Do you agree?
So I think one gauge and one comparison we can make is really the rally that took place following the 2018 bear market. Bitcoin hit a low in December of that year, and it rallied about 300% from that low into that.
Now, there's a reason why I'm showing this, and the reason is because the economic environment is behaving in interesting ways. And one of the things that I have always said is probably a good strategy is to pad yourself or protect your purchasing power. All right. We talked about purchasing power parity last year. All right. And purchasing power parity is directly linked to inflation and unstable market conditions. As we go on with this video, you will see why I'm saying this.
The high in the following June. And so that actually was a perfect 62% retracement from the previous high down to the previous low. And so when you kind of consider that and you kind of take that playbook, a 62% retracement, of course, there will be volatility on the way, but that would bring us to around 48,000 if we were to retrace a large part of the pullback that we saw. So ultimately, I think that this rally is ultimately just beginning. And just as we said earlier, it can really take hold, and especially if equities continue to remain strong and ultimately illustrate that the market is in fact better than what many have feared. And I think that the relative value of finding crypto off of its highs as equities continue to perform relatively well, I think that will kind of lead to further flows into crypto because it's still off of its highs significantly.
Where do you say further flows into crypto? Are you talking basically the two majors, ETH and Bitcoin, or are you throwing in the alts too? I mean, it seems like there's been a shakeout in the alts a bit. Some of the everyone seemed to have a layer one that had to have a coin, but I don't know. Solana's having a tough time relative to where it was a few months ago. What do you think is going to happen there to the alts?
So I think that, when you kind of consider every bull and bear market, you kind of look at the top 10 and there is a lot of change that occurs through each cycle. And I think that ultimately that will slow. However, bear markets do kind of weed out the weak, and those that deserve to stick around, those that have the use case, those that have the strong teams behind them should continue to move forward. And ultimately there are staying, there are many. I know you mentioned some of the layer ones, some of the comparisons against ETH, but there are some layer twos that have stuck around. The DeFi 1.0 is still leading in terms of the DeFi sector. So, I would look at the market leaders there, and certainly look at the developing teams, certainly look at the kind of total adjustable markets they have, and really kind of the fundamentals you could find. If it's a DeFi, there's certain fundamentals there: borrowing, lending, aggregated volume, for example. But really, I think the smart contract. A lot of people got in because it was a bull market thing. They saw ETH have, incredibly attractive returns. New smart contract platforms came along with the promise of faster transactions, cheaper at a cheaper cost. But ultimately, these are smart contract platforms that have decentralized applications on them. And users need to utilize the decentralized applications for it to be a real smart contract platform. So if there really are no applications on there, ultimately at the end of the day, what value do they have besides, it's a lower market cap, and I think it's going to rally alongside Bitcoin and ETH. So I'd be wary of kind of going overexposed. Again, Bitcoin first, ETH second, and then you can layer in some of the leaders, but I'd focus on the leaders and I would keep them kind of relatively small.
Any leaders in particular that you would focus on?
Yeah, I would look at the scaling solutions, those that continue to outperform. I like the EVM compatible specifically, and I also like DeFi 1.0 that continues to be the infrastructure around everything else that is happening. Now, of course, keeping an eye on the regulatory side of altcoins is certainly important, and those position sizes, again, need to reflect the risk that there is. But ultimately, if you are kind of a more aggressive investor within the space, you do want to own some of those altcoins because, again, of course, they're smaller in comparison, and they do have a large addressable market ahead of them, and they're slowly disrupting those traditional industries. But again, you want to be predominantly Bitcoin and ETH.
And I agree 110%. And as everybody knows, I'm biased towards Ethereum, although I do have some Bitcoin. I'm extremely biased towards Ethereum. All right. So now here it says, based on the fact that the first law of physics is an object in motion will continue in motion until an outside force affects it. Wall Street champion trader Martin S. Buzzy Schwartz wrote in his book, Pitbull, Bitcoin has rallied nearly 50% in the first 7 weeks of the year, reaching a 6-month high of $24,900. with outside forces like sentiment in traditional markets largely supportive. Recently, the crypto market and Wall Street's tech-savvy NASDAQ index have grown resilient to the Federal Reserve's angst and resulting uptick in Treasury yields. So one chart analyst expects a continued move higher that could see Bitcoin more than double in value in the coming months. Bitcoin is breaking out from a long basing formation. There is a saying, the bigger the base, the higher the space. William Noble, director of research at Emerging Assets Group and former analyst at Goldman Sachs and Morgan Stanley, told CoinDesk. Bitcoin may move from consolidation to another parabolic move back to $56,000, Noble said, having correctly predicted the cryptocurrency's late 2020 surge from $20,000 to $40,000. Going parabolic is an expression often used in the crypto market to describe an expected impulsive move higher with limited downticks. Bitcoin's recent bull revival follows a prolonged period of sideways trading at the depths of the bear market around $18,000, or the basing pattern, as Noble said. The widely tracked momentum indicator relative strength index has diverged bullishly on the weekly chart, confirming an end of the downtrend. A bullish divergence of RSI occurs when the indicator does not reciprocate the new low on the price as observed in November of 2022. That's a sign of bears losing power and bulls gaining strength. The Nasdaq's bull flag. Another good news for crypto bulls is that NASDAQ has broken out of a bull flag, a technical pattern known to accelerate an uptrend. Bitcoin's 90-day correlation coefficient with NASDAQ has increased to 0.75, indicating that the two assets are moving in tandem. Now, this is going back to basic statistics class. What is a perfect correlation? All right. A perfect positive correlation is 1. So that means that if the number of the correlation index is 1, that means that they're moving in the exact same pattern. If the number is -1, that means that they're moving exactly opposite of each other. So being that this correlation coefficient is 0.75, that means that when it comes to Bitcoin in a 90-day period, in most cases for 90 days, Bitcoin is moving about the same as the NASDAQ. In NASDAQ, there's a bull's flag. There is a saying, flags fly at half mast, meaning there could be another major run higher in equities to a new all-time high, Noble said. A bull flag forms when a correlation follows an initial steep rise. An eventual breakout from the flag is said to confirm a resumption of the broader trend. NASDAQ fell by 37% in 11 months to October 2022. The decline, though severe, looked like a correlation in the broader rally from March 2020 lows and represented a flag pattern on the weekly chart that recently ended with a bullish breakout. Said differently, there could be a new bull market in stocks that looks like the last bull market. 2023 could be a surprisingly good year for both crypto and equities, Noble noted. Interestingly, NASDAQ's daily chart also shows a bull flag breakout, as popular analyst Declan Fallon noted. Okay. Ethereum, the second largest cryptocurrency by market value, is yet to break out of an expanding triangle, identified by trend lines connecting January 21st and February 2nd highs and lows, registered on January 25th and February 13th. Per Noble, a potential breakout might bring outsized gains in Ethereum's native token. The expanding triangle in Ethereum is potentially very bullish. I saw formations like this in 2009 and 2010 when stocks rallied post-global financial crisis, Noble said, pointing to the S&P 500's expanding triangle breakout of 2009. All right, so that's pretty interesting. Basically, what it's saying is what we can look forward to in the near future are some pretty big gains when it comes to cryptocurrency and some pretty explosive breakouts. Okay. And people are probably going to need that. If you are a investor, or, just if you are somebody that happens to use the world financial system, which is more than likely everybody, you're going to need something working in your favor. And the reason why is because just because these financial markets look good, it doesn't mean that the global economy is doing well. Here's an article from Crypto Slate, and it says inflation, interest rate hikes continue to wreak havoc across the US, EU, and UK. And immediately, when we talk about inflation and interest rate hikes, what does that mean? That means that the price of goods is higher and it takes more money to purchase something, and it would be higher than it would be under normal circumstances. We're going to look at an article from the Times to see what's going on in the UK, because we've talked about what's going on in the UK before, and the financial crisis has not let up. The financial crisis here in the United States has not let up, and that's something that people should really pay attention to and really consider when they're going to the polls to vote in 2024. The mantra across central banks is higher for higher, as the U.S. money market swaps price at a peak rate of 5.5%. Money markets continue to price in higher peaks for central bank rate hikes, which includes the U.S. and the EU, as economic growth is holding up better than expected as CPI inflation continues to run hot and yields continue to rise. The mantra across central banks is higher for higher, as the U.S. money market swaps price at peak rates of 5.5%. The future Fed fund rate is consistent with three additional 25 basis point hikes with no rate cuts until 2024. The EU. Inflation continues to riot in Europe, as the Eurozone headline inflation was forecasted to fall to 8.3%. However, it slowed down to only just 8.5%. Energy inflation dropped considerably to 13.7% from 19%. However, the issue that raised concern was core inflation rising to a record high of 5.6% against 5.3%. February S&P manufacturing PMIs for the southern region, which is Italy and Spain, rose far more than expected in expansion territory. At the same time, Germany's unemployment rate remained at 5.5% for 7 months, indicating a more resilient workforce than expected. Now here comes home, the United States. The U.S. house price declines accelerate. So I don't know if you guys have been paying attention. I haven't really had a chance to do any content on this, and I plan to, but there's been a market issue when it comes to U.S. real estate. Housing prices are falling swiftly. All right. And apparently, according to this article, that increase of price falling is going to continue to accelerate. Okay. U.S. house price declines accelerate. All right. That means that they're getting lower faster. OK, the S&P CoreLogic 20 City House Price Index fell faster than expected, which saw the year-over-year price growth rate down from 6.8% to 4.7%. This index is a lagging indicator of prices on a 3-month average, going back as far as Q3 of 2022. While 30-year mortgage rates have topped 7% again, mortgage applications for home purchases fell as much as 6% last week, following an 18% drawdown the week prior. Now here it says the U.S. economy is still hot. ISM services got released in March 3rd, which showed the economy of the United States is still going extremely strong. Services were better than expected, lower prices paid, stronger employment, and stronger new orders. All eyes on FOMC. The next FOMC meeting, which takes place on March 22nd, will include an update of the Fed dot plot and an update on the summary of economic projections, which will have greater significance than just a 25 or 50 BPS raise by the Fed. The UK, record flood inflation. Troubling times are ahead for the UK as shop price inflation accelerated by almost double digits in February, while food price inflation reached a record 17.1%, according to the British Retail Consortium. BOE caught between a rock and a hard place. Yields up, GBP down, and BOE struggles in many different ways. Unlike the Fed and ECB, who have devised a hawkish plan for 2023, the BOE continues to flip-flop with no clear direction. The pound, which is now at $1.19, approaches a year-to-date low, while the curve continues to steepen. Okay, so as you can see, it's not stable in the economy. Things are very volatile right now, and when it comes to the euro and the UK pound, very, very volatile. Okay, very price sensitive. All right, what we have right here is an article from the Times, and this is just an example of how these economic conditions impact everyday affairs. All right, grocery price inflation has hit a record in the UK of 17.1%. All right, so now a lot of people in the comment sections of my videos when we are live talk about the price increase that they've seen at the grocery store, how much eggs cost, how much meat costs, how much bread costs. If you guys didn't check out the Russia report and the Ukraine war series, make sure you guys check out those videos, because those explained a lot of the previous events that were set into motion that triggered a lot of this global financial rift. All right, so now here it says grocery price inflation has reached a high of 17.1% this month, adding to the squeeze on households in the cost of living crisis. Prices are rising fastest in markets such as milk, eggs, and margarine. Data from the market research Kantar showed. It says the rise in food costs in the 4 weeks to February 19th would add a potential £811 to annual shopping bills. Fraser McKevitt, head of retail and consumer insight at Kantar, said this February marks a full year since monthly grocery inflation climbed above 4%. This is having a big impact on people's lives. Now, why are we talking about this? We're talking about this because what goes on in the UK tends to happen here in the United States. The UK and the United States are very similar countries. They have very similar dynamics, especially when it comes to the financial markets. We see a lot of what's going on in the UK happening here in the United States. So if we can get an indication outside before we have to deal with it first, it's always good to heed those warnings. And if you ask me, this is definitely a warning sign. Okay. So now here it says, he said its research showed that the grocery price inflation was the second most important financial issue for the public behind energy costs, with 2/3 of people concerned by food and drink prices, above public sector strikes and climate change. 1/4 say that they're struggling financially versus 1 in 5 this time last year. The numbers speak for themselves. All right. So now 1/4 is 1 in 4. You know what I'm saying? Versus 1 in 5 this time last year. Okay. Although consumer price inflation has been falling, down from a peak of 11.1% in October to 10.1% in January, household incomes are under pressure, not only from higher food prices, but cuts in government support on energy bills and rising mortgage costs as well. Kantar said that sales of own label products were up by 13.2% in February, well ahead of the growth in branded products, which are generally more expensive, of 4.6%. It said that UK grocery sales increased 8.1% over the 12 weeks to February 19th, masking a drop in volumes when accounting for inflation. The data was published as supermarkets face shortages of fruit and vegetables. All right. So now we're not dealing with food shortages as of yet. We're not dealing with food shortages as of yet. But what we are dealing with are higher food prices. But now here's the question. Okay. Here's the question. Do you all feel that it will be likely in the future that we will deal with food shortages? Now, why do I say that? Oh, who cares? What does that matter? What does that have to do with us? Well, what that has to do with us, as far as that goes, is Dr. Claude Anderson warned people about food shortages. And hopefully, you know, people pay a little bit more attention to those warnings that Dr. Claude Anderson gave than they have some of the other warnings that Dr. Claude Anderson gave. Kantar said the shortage due to supply chain issues was not captured in its data, but it would closely follow the impact on sales in the coming weeks. McKevitt said, McKevitt said, while 43% of all grocery baskets contain at least one fresh, See, this is what you got to love about these, about some of these sites. They just jump all over the place. Okay, here we go. All right, I apologize. Make sure you guys smash that like button. See, anytime I make a mistake and the video is long and I'm not going to go back and do short edits, anytime I'm stuttering, anytime I can't read a word, make sure you guys just bang on that like button and also share the video out. And if you're not subscribed, go ahead and hit that like button. Go ahead and hit that bell icon twice. So let's try this again. McKevitt said, while 43% of all grocery baskets contain at least one fresh produce item, pack limits are unlikely to drastically affect consumers, as we usually buy fruit and vegetables in smaller quantity. For instance, only 1% of tomato purchases last year involved more than 3 packs. Sales were boosted by Valentine's Day. Steak sales rose by 1/4 in 7 days to February 14th compared with the previous week. Sparkling wine sales doubled, and shoppers spent an extra £5 million on boxed chocolates. Sales of cold treatments also rose by 82% last month, with cough liquids up 78% and cough lozenges 70% higher. Aldi and Lidl, the German-owned discounters, were again the fastest growing grocers, partly due to new store openings, with sales up 26.7% and 25.4% respectively. Aldi's market share rose to 9.4% and Lidl's to 7.1%. Sales at Tesco, the market leader with a 27.3% share, rose 6.6%, with Sainsbury's up 6.2% and Asda up 5.9%. Morrison's was the only supermarket to report a fall in sales, down 0.9%. All right. So, yeah, they're dealing with food shortages. And in addition to dealing with the food shortage, they're dealing with inflation as well. All right. So we're going to take a quick look at an article that goes into the food shortages, and hopefully talking about this will help get people thinking about how they plan on dealing with a food shortage if that happens to occur here, which it will. It's only a matter of time. So my question for everybody in the comment section that I hope you guys answer is, how do you all prepare for a food shortage? Let me know. Now, here's the article here, and it says fruit and vegetable shortage will last weeks, former food secretary warns. All right. Now, here it says shortages of fruit and vegetables in Britain's supermarkets will last for another 3 to 4 weeks, a former environment and food secretary has warned. George Eustace said today there was nothing much that the government could have done to prevent empty shelves, even though shops in mainland Europe appear to be fully stocked. His comments came as Mark Spencer, the food minister, announced that he would hold talks with supermarket bosses tomorrow on how to tackle the crisis. For the past week, shoppers have seen fresh produce rationed at Aldi's, Asda, Morrison's, and Tesco, as the shelves that are normally full of tomatoes, cucumbers, and other salad items have stood there. The stores have blamed bad weather conditions in Spain and Morocco for the problems, but social media has been flooded with pictures of supermarket in mainland Europe full of the same goods. Food industry experts say that extra paperwork because of Brexit and higher transport costs have discouraged overseas producers from shipping their limited supplies to Britain. In winter, the UK imports more than 90% of its tomatoes. Speaking on the BBC Sunday with Laura Kussenberg's show, Eustace, who was Secretary of State for Environment, Food and Rural Affairs until September, and before that the Food Minister, said he expected the problem to last about 3 to 4 weeks. He blamed a quote-unquote cocktail of weather events and added that food prices were always closely linked to energy prices, which rose sharply due to the war in Ukraine. All right. And again, this is one of the reasons why I tell people, make sure you guys go back and check out the Ukraine series. All right. Domestic producers say that shortages could last until May because high energy costs for heating their greenhouses have forced them to delay planting their crops. Eustace added there was not much different in the government what they could have done in recent months, and that there was nothing they can do immediately to avoid shortages. However, the food industry has been warning ministers for months about fragility in their supply chains because of labor shortages since COVID and restrictive migration rules since Brexit, as well as increased bureaucracy at the border. In December, farmers asked ministers to take urgent action to avoid empty shelves, with the National Farmers Union warning that Britain was sleepwalking into a food supply crisis. At the time, it called on the government to ensure producers were given a fair deal by retailers. It has emerged that during negotiations this August, supermarket chains told British growers that they would look abroad for supplies rather than increasing their payments. Lee Stiles of Lee Valley Growers Association, which produces much of the homegrown tomato, cucumber, and pepper crop during the winter, said that supermarkets had gambled on imports, but the strategy had failed. There weren't the issues we are having with weather and transport that we are having this year. So it kind of went unnoticed last year. You start talking in about September or October because you need about 30 days or so to order your plants and to have everything delivered and ready for December. In 2021, supermarkets dragged it as long as they could, and it meant there wasn't time left to order the plants and get staff in all the rest of it. It just wasn't logistically possible. This year, they basically said, we are going to concentrate on increasing imports from Spain and Morocco, even Turkey and Egypt, and it has failed, Stiles told the Yorkshire Post. Stiles also blamed post-Brexit decisions by the government for increasing the cost and challenge of importing vegetables. He said, of course, now it is a lot easier for Southern Europe and North African producers to drive their goods into Europe instead of a 4-day road trip to the UK, sitting in queues, coming back with an empty lorry, and dealing with all the additional paperwork and customs fees. It's about 40 pounds a pallet, and I think when we are in the EU, it was nothing. He also accused ministers of concentrating on sourcing vegetables from even further afield, such as Mexico, rather than supporting national producers. There is no talk about supporting British growers, he said. Andrew Opie of the British Retail Consortium, which represents supermarkets, said that importing food from abroad was cheaper than using greenhouse-grown produce from the UK, and therefore allowed them to offer best value for money to customers. He added that the stores understand they need to pay a sustainable price. All right. So, yeah, this is an ongoing issue that's going on in the UK. And like I said, usually what you see is issues that happen in the UK tend to find their way back to the United States. So with that being said, if they are dealing with food shortages in the UK, do you all think that it's inevitable that we will be dealing with those here? And if we will be dealing with those here, how do you plan to deal with not only the absence of food, but the increase in inflation, which makes the little food that's there more expensive because of inflation, and also because the supply being lower, it's going to drive the price up as well. Anybody that's watching this video that's from the UK, please feel free to leave in the comment section any corrections that you may want to leave, or also any additional information. That would be great. Make sure you guys share the video out, smash the like button, hit the bell icon twice. Make sure you're subscribed to my backup channels, and I will catch you all on the next video. All right, peace.